Hi everyone, this is Nooresh Merani, and today's topic is how to trade small caps and mid caps using technical analysis. So in this we'll try to cover it in three different parts. First, why to trade small caps, when to trade small caps, and how to trade small caps. So let us start off with the first section, why to trade small caps and mid cap. Before that, try to understand what is a mid cap, what is a small cap, what is a large cap. So it is categorized by market cap. Now what is market cap? Consider the company has 20,000 shares which are outstanding, and the stock price is say 20 rupees. Now the market cap is equal to number of shares into the current market price. So that will give you 20,000 into 20 rupees. That will give you a market cap of 4 lakh. In the same way, there could be companies which would have market caps of 100 crores, 1000 crores, 5000 crores, 5 lakh crores, etc. So this is how you categorize market cap. And once you have market cap, the SEBI classification or categorization is into small caps, mid caps and large caps. So if we look at the structure of Indian markets, roughly the top 100 companies are around more than 40 to 50,000 crores of market cap. Now these companies are called as large caps. Between 101st to the 250th, it is called mid caps, which generally have a market cap between 15,000 to 40,000 crores. Now everything below 15,000 crores is considered to be small cap. Now this is the way SEBI does the categorization. In terms of liquidity, anything below 100 crores of market cap becomes very, very difficult to trade in India, given that we are a market where promoters end up owning 75% of equity in a lot of small caps. So in that case, for us, the small caps would be something between 100 to 15,000 crores. Now that is a huge range and there are a lot of companies in this basket. Now, why do we have a problem trading small caps? Now, you got to understand when you're talking about small caps or say any penny market caps, these are generally very small companies which have very small turnovers and small profits compared to the larger scheme of things. They may not be very well organized. They might not be a very scalable business at times. So there are times where a company is really small and in a very small segment. As you go into mid caps, these are very well established companies. So when you look at a company like Marico or other FMCG companies, you would have heard about these names. But when you come to small caps, there will be a lot of companies which we talk about which you may not have heard about also. In the same way, when we talk about large caps, these are very well established companies which have been around for decades. For example, you would have heard about Reliance Industries, Tata Consultancy Services and various such large companies which have market caps in lakhs of crores. So the segment which we will be trying to focusing on would be the small caps. Now, the problem is small caps inherently have a higher risk and a higher volatility compared to the large caps. Now, when I talk about this, we've seen various market cycles. So for example, in 2008 crisis, the small cap index itself fell by 70%. Even in the cycles between 2011 to 13, 2018, 2020, we've seen small cap indices fall by 40 to 60%. And this is the kind of risk which is there. But let me tell you, even in 2008, even the large cap index fell by 60%. So the risk is same, but there will be much bigger moves in the small caps on both the sides. So the falls will be larger, the moves will be larger as well. Now, there are various indices which capture these companies. So the major indices which we know about are, first is Nifty 50, which is about the large caps. The Nifty Next 50 is basically the next 50 companies. So this becomes the Nifty 100 companies. Then you have further indices called Nifty 200, Nifty 500. For the small cap indices, there are multiple indices, but the two main ones which we look at is the Nifty Small Cap 100, which is basically 100 companies, and BSE Small Cap. Now, BSE Small Cap comprises n number of companies. It does not have a limit to the number of companies. Anything which is in the bottom 15% of the total market cap comes into BSE Small Cap. So that is one of the major index which we look out for in terms of the small caps. Why to invest in mid caps and small caps? So if you look at what happens in the industry right now, everyone tells you to invest for the long term and do not time the market. But the fact is, if you look at the overall returns of Indian equities, you will be hearing about this fact of that Indian equities have given a CAGR of 15 to 17% and starting from the 1980s. But the fact is, if you look at the returns for the last 20, 25 years, 15, 20, 25 years, the CAGR of Nifty comes very closer to the 12% mark. So it's between 10 to 14% over a rolling 5-year, 10-year, 15-year periods. Now, this mask off the actual returns. When we talk about 15-17%, which the industry keeps telling you, it takes data from the 1980s. In 1979, the Sensex starts from 100. Although Sensex got established in 1986. So the first 7 years of data is backdated. From 1979 to 1992, the peak of Harshad Mehta, the index Sensex went from 100 to 4500. Do you think in your lifespan, you'll get a time where the Nifty goes up 40x, 45x? I don't think so, right? So the reality is the large cap return is higher double digit, and it's not going to be 15 to 18% over a long period of time when the interest rates are going to be 6 to 8%. Back in the 80s, the interest rates were very high double digit. So then we look at the fact that why timing the market?
Hey there. Sorry for interrupting you guys, but before we continue with the video, I would like to highlight that this is not an individual video, but rather a part of a 10 video series where we will discuss how you can make money from small and mid-cap stocks. Make sure that you share this video across so that once we reach 6,500 subscribers, you can get access to the next part of this video. So now go and continue learning.
Right. The industry will always tell you to not time the market. But let us see what happens if you time it wrong, right? So timing can be either you're right or you're wrong, right? That is the way you are made to think, that it is always black and white. So let us see what happens when you go wrong and how long is long term. So consider you invested in the peak of 1992. The index was say around 4,300, 4,500. What happens to the index over the next few years? So how do we calculate the returns? One is to calculate CAGR. The other way is to very simply put it in a very baniya hisab, कितने साल में पैसा double होता है, right? That is the way we think, right? How many years does it take to double? When you go to a fixed deposit, you say how many years to double the money. So let us see if you invested in 1992, right at the peak, how many years did it took to double your money? It took you 14 years to double your money. Whereas it would have doubled in less than half the time in any other fixed income product if you would have bought it in the 1990s, right? So if you go wrong, it could be a 14-year problem also to actually double your money. You can call it a 14 saal ka vanvas if you go wrong. Let us say the next cycle, right? You bought it in the Y2K boom in 1999-2000. The index was roughly around, the Sensex was around roughly 6,000. It took you 7 years to double your money. Now, this is irrespective of the fact that you had one of the best bull markets between 2003 to 7, but it still took you 7 years to double your money. Next, we had some of the biggest moves in 2003 to 7. Then we had a big bear market in 2008. Suppose you bought right at the peak of 2008, in January 2008. The Sensex was 21,000. It took you 13 years to double your money. Now imagine how long can it hurt if you time it wrong, right? So that is the fact. How long is long term? How long can you wait? And that is the reason, what do you want to do? You want to get into some bit of timing. But the problem is we consider timing is to be sell 100% of your portfolio at top and buy 100% of the portfolio at the bottom. This is not going to happen. But you can always go along with a better asset allocation wherein you could be at 10 to 20% cash right at the top and 10 to 20% extra equity at the bottom. So what we see is if you go wrong on timing, it can take you between 7 to 14 years to actually at times come very close to the fixed income returns. So now let us see on the opposite side of it. What happens if you time it right? Now, some of the biggest bear markets, if you look at it, the first fall was in 1993 when the index fell after Harshad Mehta peak. How many years did it take you to double your money? In that case, it took you 7 years to double your money from the bottom of 1993. Then the next bottom came in after the Y2K boom. Now this was the best period. You doubled your money in 3 years if you bought it in the bottom. Next, you had a big correction back in 2008, wherein the markets fell by 60%. It just took you 2 years to double your money from the bottoms in 2008. Then which is the next big correction which we recently saw? The COVID fall. From the bottom of COVID at 7,500 Nifty, 8,000 Nifty, it took you 2 years to double your money. Now see the difference. If you time it wrong, you have a big problem for a long period of time. But if your timing is right or very close to being right, you have some of the best possible returns in a very short period of time. So what do you want to ideally do in this case, right? You don't want to be on the black and white side of it, wherein you say, I'll be right all the time, right? The only guys who catch tops and bottoms are absolute liars. Even God cannot catch it. So if I were to tell you that 24th March 2020, you'll have a lockdown in your country, in your world, if you got exactly what would to be happen in the world, would you say the markets would have bottomed right on 24th March 2020? Right, we were struggling at that point of time. But when did the markets bottom out? On the worst possible news. So do you think you'll be able to catch exactly the bottom or exactly the top? No. So what should we be doing it? So what we want to do ideally is be able to time it well in terms of part of the portfolio, wherein you go aggressive, wherein you go defensive. So that is what we'll be trying to do. And that is where the first part of it is, why timing the market is important. Because if you time it wrong, it can hurt you for really long periods of time. So the best case is to be going into cash 10, 20, 40% as per your asset allocation at the upper end of the markets, which we'll try to see how it comes through, and be able to deploy much more of your cash into equities right at the bottoms. Now, consider this, you are able to sell off 10% lower some part of your portfolio from the top and 10% higher from the bottom. Your outperformance in that period of time, if you could do that with only 10% of your portfolio, you'll be beating every other, say, mutual fund or other avenues which you have, if you could time it well with your cash. And if you can do it over cycles, your outperformance does not require you to have a very strong selection of stocks. Yes, I'll say it again, it's not necessary to have the best selection of stocks. Now, that is where we go to the next topic, right? We have this whole, focus on selecting the best possible stocks all the time, right? We think that stock picking is the ultimate skill. Let us see what is actually a random return versus a skill return. So what we do, this is this is an exercise which I started whenever we got a great time. Back in 2009-10 was the first initiation when the markets doubled up in a couple of years. Then in 2014. So this was a period of time where the initial exercise was you would just pick up random stocks, take that Dalal Street Journal, Capital Market, just mark out random names. This was back in 2009-10, and you would see the random portfolios outperformed your portfolio. In 2014, we had a great year. The markets really went up. The small cap index went up really fast from August 2013. It bottomed by the time we were in August 14. That was the time what we did is we actually made this as an exercise which could be done in an Excel or any of the programs. So what do is we create a random portfolio and try to match it with the Nifty, the small cap index, and then you try to match it with yours. So what is a random portfolio? So a random portfolio, the way we've kept it is very simple. 25 stocks, equally weighted. So for example, you have 1 lakh rupees, 4,000 rupees put into each stocks, each of the names. Now what is the selection filter? What we've done is we've taken all the NSE stocks above 5 rupees. We've just had a random 5 rupee thing so that it removes out some of the very illiquid, very small penny cap companies. Ideally it should be market cap, but a price filter is easier to put in all the softwares which give you the price data. So an equal weighted portfolio, 25 stocks, so it is not very concentrated and it's not very diversified. So it's a decently diversified portfolio. Now what we do is we do a random portfolio return from time to time. So what happened between 2008 to 10, 2014 to 15, etc. So let us see what happens in the Nifty peaks and bottoms over the last few years. Now, in 2008, from the top to the bottom, the Nifty fell by around 55 to 60%. Your random portfolio fell by 66%. Your small cap index was down by 70, 72%. Now the next part, you saw a full recovery from the bottoms. The Nifty went up 210%. The random portfolio was almost similar at 220%. The small cap index was up 150%. Now, as we look through all the cycles, what do we notice is the random portfolio outperformance is huge on the way up, and it is almost very similar to the index on the way down. Same way in 2010 to 2011, the Nifty fell by 25%, the random portfolio fell by 40%, the small cap index fell by 50%. Same way then between 2011 to 2015, the index is up 90%, the Nifty, the small cap is up 108%, but your random portfolio is up 190%. Now that's a huge outperformance, right? Then in 2015 to 16, Nifty falls by 20%. The random portfolio is only down 1%. Now this was one period of time where the markets did not fall as much as the index fell. The small cap index was down 14%, relatively lower to the Nifty. Then we go to another period between 2016 to 2020, wherein the Nifty did really well compared to the small cap in period between 2018 to 20. But if we take from 2016 to 2020, that 4-year cycle, the Nifty is up 65-70%, the random portfolio is up 45-50%, and the small cap is also up 45-50%. In 2020, another big fall which we all remember, very recent, the Nifty fell by 32%, the random portfolio fell by 42%, and the small cap index was down 38%. Then we saw this huge rally from 2020. The Nifty is up 120%, your random portfolio is up 280%. The small cap index is up 200%. Now look at this period of time between 2009 to 10, 2011 to 14, 2016 to 20, and 2020 to 21. In this periods, what we've noticed in every bull cycle, the random portfolio almost performs double of the Nifty and almost 30-50% higher than the small cap index. So that's a huge alpha which can be made in that cycle using small caps. So what do you want to do in this case? Ideally, you want to what? Participate in small caps in such cycles. Now let us look at the same comparison only for what happened from the bottom to top in 2020 and 2013 to 2018 in the small cap index. Between 2013 to 2018, the small cap index went up by 275%. Your random portfolio was up almost 500%, very close to that. Between 2020 bottom to 2021 top, your small cap index is up to 35%, your random portfolio is up 300%. Right? Like I said, almost 30 to 50% outperformance to the small cap index. So what does it really tell you? Right? That first of all, if your timing is somewhat right, you don't need to be selecting the right stocks. You could just randomly buy any portfolio, you'll beat the Nifty, you'll beat the small cap by a huge margin, right? So what do you need to focus on? Trying to get your asset allocation, equity allocation, timing little bit right. You don't want to be exactly right. You don't want to be exactly wrong. You want to be somewhere in the middle. Now, what was the learning from the random portfolio, right? That we tend to consider ourselves really smart in bull markets, but then we realize our returns are almost closer to the random portfolio or lower than that. How can you beat that random portfolio? You can only beat it via concentration. So if you were to create a portfolio very similar, 25 stocks equal weighted, I can bet you will not be outperforming the random portfolio by a big margin. And we've tried to do a lot of exercises, lot of iterations on the random portfolio. So what we realized is the way to beat a random portfolio return is via concentration or via timing. Now, what do we see also from the factors? When the markets correct, the small caps tend to correct a lot more. So that is the point of time you want to have lesser allocations to small cap. So that is what we'll consider in when to trade small caps. So that is what we'll try to do. When to participate in small caps, that would be the section later on. Now, so what are our conclusions when we look at this various cycles? Timing in the market is important. More important than time in the market many a times. Because if you get it right, your outperformance can stick for decades. So if you have doubled your money in the bottom of 2020, all you need to do is conserve and you will still be outperforming the indices for a long period of time. Participating in the small caps in a strong bull market can give you huge outperformance. And exiting on the way down or getting your allocations down from small caps to large caps or going towards cash can give you huge outperformance. So the fact which I say is basically, my principle is तेजी में इतना लूट लो कि मंदी से फर्क ना पड़े. In real terms, you outperform so well in the bull market that the bear market can be easily digested. So that's the way to look at it. So how do you participate? Participate so well in a bull market that the bear market corrections can be easily digested. So that is the motto I go with. Go aggressive in the right times. So, and the final thing what we realized when doing random portfolios is, it is very easy to say I want to own a multi-bagger, but it's very difficult to continue to own a multi-bagger. Say a random portfolio Excel sheet entry of one stock which is 4% allocation, which goes up 20 times. At some point of time, it will become 20, 30, 40% of your portfolio. Will you be able to hold on to that sort of concentration? Not that easy. It seems very easy to own a multi-bagger, but the reality is very difficult, right? So that is what we learned is riding winners is difficult. So, but doing a little bit of timing is a little more easier if you can keep your asset allocation rules, which we'll be looking at further. So nobody will encourage you to time the market because the longer you stay, it is the best for the asset management industry, because the asset management industry is the only industry where the SIP money comes in the first week of the month exactly on time. There is no other business in the world where the payments from the clients come right on time, right? The whole world is going towards a subscription model for the same bloody reason, that the money should come as on the date which has been prescribed to you a month back, right? So what we'll try to do is time. Do not time to be extremely right or extremely wrong. Try to be in the middle, right? And what do we see is, if you could do it across time cycles, your CAGR returns against the Nifty is huge. So from the bottom to the top, we've seen the comparison. Even if you look at CAGR returns of the Nifty, say from the top to bottom, if you're invested across small caps, you do get an underperformance, but it is not that huge if you can cover up it in the next cycle. Say for example, if you bought at the top of 2008 and held it for a long period of time for the next 14 years, your Nifty CAGR is 7.5%, your small cap CAGR is 5.5%. But this can be covered if you have done a little bit of timing across cycles. So to conclude, what are we trying to do? Try to time a little bit right. And when the timing is right, participate in small caps, participate aggressively, and generate a lot of outperformance, like what we saw in 2020 to 2021 or in 2014 to 2017. So that outperformance is pretty high and it can allow you to digest all the bear markets in the interim. Rest, we can always optimize all this via allocation. So simply put, what are we trying to do? Get into small caps and get it in the right time. And that is the best combination you can get. We'll see further when to buy small caps, how to buy small caps as we cover in the sections going forward.